Good morning, everybody, and thank you for joining us this morning for FinPro's Emerging Series webinar. Today's topic is going to be on commercial real estate, multifamily, and discussing whether or not there's a bubble, and also talk a little bit about the regulatory implications as well as what to do to prepare yourself in 2017 to make sure that you're doing all the right things from a risk management perspective. My name is Greg Garcia. I'm an Executive Managing Director at FinPro. I'm joined by Scott Polikoff, Executive Vice President, awesome regulator. I'm sure everybody knows who he is. Before we get started, there are definitely a few new folks on this webinar, quite a few new folks on this webinar. So I just wanted to kind of talk a little bit about logistics for today's webinar. The first thing you want to know is if you're a New Jersey-based institution and you're looking for CPE credits, you can type in CRE2017 into the box there, and you can we'll make sure that you get the appropriate information to get your credits. For those of you who would like to ask a question, what you can do as well, there is a dialog box. You can type in a question, and we'll be monitoring those throughout the webinar. And we will address them when there's a good moment to go ahead and do that. Scott, before I begin, anything you want to discuss?
I just want to offer, Greg's put together a great deck. There's a lot of material. We're going to try to get through all of it or as much as we can. This is going to be recorded. The presentation will be available to everyone. We're going to, as Greg said, try to address questions as we can, but it's critical that we get all this great research and information out to everyone.
Yeah. In addition, for those of you who are attending, we have a checklist actually that we think is a really good takeaway. If you want access to that checklist, what you'll need to do is email me. My email information is actually at the end of this webinar. If you email me, we'll make sure that we'll get the checklist off to you so you can share that with the rest of the members of your institution. So with that, I'd like to get started, jump right into it. So really what we're talking about here, is there a bubble, right? And so the first thing I wanted to do off the bat was really define what a bubble is, right? And so when you look at this definition here, and I'm not going to read it verbatim, but really what a bubble is when pricing appears to be implausible or inconsistent with kind of the views about the future. And if you looked at transactions that have really taken place over the past several years, there's been a lot of pricing appreciation, if you will, because of where the 10-year Treasury rate has gone and where interest rates have gone in general. It's really been abnormal relative to historical views, and we're going to show some data that proves that point. But what I also thought was interesting when I was looking up this definition was that usually bubbles are defined after the fact. Okay, so it's not until the bubble actually bursts that people go back and say, oh yeah, that was a bubble. What we're trying to do today is actually determine whether or not there is a bubble and really what to do to prepare yourself in the event that that does happen. So let's just look at some industry data and really why you've been hearing a lot about, certainly from regulators and examiners and industry folks about this idea of a commercial real estate concentration. It's really been all over the news. I know there's actually some M&A activity last year that occurred because of the concentration issue on the table. And so when you look at this page here, you can actually see the reason why, right? Commercial real estate loans at commercial banks has really skyrocketed since 2012. And that's a pretty overwhelming chart. And actually, when you look at the kind of the slope of the curve, it's not that inconsistent with where we were back in 04, 05, right, leading up to the Great Recession. So when you start looking at historical trend analysis, you start to look at, well, that looks eerily similar to what happened before the Great Recession.
And the key thing for all of us to remember here is this volume being driven by economic expansion? Well maybe. Or is this volume being driven by inconsistent or unacceptable underwriting that's driving volume? And Greg's going to talk about a number of these issues. And listen, we've got a couple hundred banks on this webinar from across the country, so the notion of concentrations and bubbles are going to be very geographically specific. So Greg's going to talk a little bit about macro issues, and then we're going to show some micro issues. But make no mistake about it, for everybody on the line who comes from a regulated financial institution, the OCC, the FDIC, and the Federal Reserve believe there is a bubble and the bubble is going to burst. The question is, how do we define what that bubble is?
Exactly. So as we break down a little bit further and actually go over the last 8 quarters and we start talking about commercial real estate on a national level, you can see again that the volume has increased over 20% in the last 8 quarters in terms of commercial real estate outstanding. That's pretty interesting. I think that's, I would think be categorized as pretty aggressive growth in this asset class. It's really a lot of it when you look at the mix. The mix has actually also shifted to more of a multifamily focus, right, and also construction. So multifamily and now even construction as a percentage of total commercial real estate has also increased over the past 8 quarters, which I also think is an interesting trend and a warning sign to some degree. On the flip side, though, when you look at delinquency levels as a percentage of total commercial real estate loans, they're pretty much at all-time lows, right? So it kind of makes sense, right? Volume is definitely gone up. The market has definitely rebounded from the Great Recession, so delinquency volumes are low. But again, that doesn't necessarily mean that there's not a bubble forming and that it could burst at some point in time. If you go back to 2006, delinquency levels were similar to where they are today before all of a sudden all hell broke loose and we started to see an increase in overall delinquencies.
Yeah, and Greg's going to address it later on. Delinquencies are obviously a lagging indicator of a problem, and we're seeing, as Greg's going to mention, a volume of IO underwriting that can very well mask repayment capabilities, and we're seeing IOs in ways that we've never seen them before and don't align with the purpose of the loan. We've seen some amortization schedules that are unreasonable and again don't align with the purpose of the loan. And quite frankly, we're seeing an interest rate environment that as rates rise and some of these loans reset, and Greg's going to talk about that, it's going to create a meaningful problem.
All right. So breaking down and then going into charge-offs, looking at charge-offs, and I thought this was a pretty interesting slide as well. Again, lagging indicator, just Scott just pointed out, charge-offs obviously are at all-time lows as well. However, if you go back to the last recession, you could actually see, and if you go back to 1991, which everyone will remember was the big S&L crisis, charge-off levels reached as high as 3% overall in terms of commercial real estate, charge-offs as a percentage of commercial real estate loans. So when I looked at that, I said, that's interesting. But what asset class within commercial real estate did that really affect? And so I broke it down a little bit further on the following page and found that the primary driver of the charge-offs was construction loans. No surprise, I think, to anybody on this phone. The glut of construction that was put on during the boom years in 2004, 5, and 6 really came to a crashing halt. But what I've been hearing over the last several years is, well, it wasn't really multifamily, it wasn't commercial real estate that caused the problem. And while that's true, charge-off levels did also increase in those areas. So I think it's important for everyone to understand when they're doing their stress testing, if we go back into some type of recessionary period, what can we assume that some level of charge-offs that may be? And you can kind of see the numbers that are bearing out there. I think minimally they end up there. It could even be worse because of where values have gone.
And this is, it's kind of interesting as we go around the country and give speeches and interact with various community bankers. A lot of bankers are back in the spec construction business. And all of you who are on this call, there's probably a good chunk of you who are back in the spec construction business and can support it for why it's a good business to be in. But it's just another warning sign that we're looking at and we know the regulators are looking at.
And there's no doubt that commercial real estate, there's certainly pockets around the country where commercial real estate is more prevalent in terms of an asset class on bank balance sheets. When we break out the banks that have over 300% commercial real estate concentration, and I don't need to define that, but that's the kind of the line in the sand that the regulators have put out in the guidance that Scott's going to reference later on, that the most of the banks are located in the Mid-Atlantic, or I should say as a percentage of the banks in those regions, in the Mid-Atlantic and Northeast. There's quite a few in the Midwest, but that's a bigger swath of market of overall institutions. So I think that's just as interesting from a concentration perspective.
You know, and we are going to talk about it later in the presentation, but since Greg referenced the 300% threshold, I think everybody understands on the call that the 2006 and 2015 regulatory guidance that aligns to that 300% threshold for total CRE and 100% for land and construction. The 300% ratio also has with it a trigger that says plus a 50% growth rate over 3 years. That aspect of the guidance is most often ignored by the regulators, but we're even seeing a more interesting trend from the perspective that the regulators are dropping below the 300% threshold as they analyze the CRE concentration. And we're seeing examples now of 250, 260, even 275, where the regulators are saying, listen, we understand you're not above the 300%, but all the best practices that are described in the 06 and 15 guidance apply to you because you're starting to approach that level.
Yeah, and quickly, if I could just add one thing there, Scott. The most extreme case I've seen is a bank who's only 58% on that concentration threshold, but because their strategic plan post-conversion called for growth in CRE lending, the regulators in their first exam post-conversion have asked them to up their stress testing levels.
Yeah, I mean, that was Steve Musso with that thought, and I mean, he's spot on. So we really need to be prepared. It's good. The regulators are really going to be looking at this a little differently in 2017, more aggressively, unfortunately.
I think for those people on the phone, later on in the presentation, stick around. I know we've got about an hour, but stick around because at the end we're going to really be going over that playbook. Regardless of your concentration level, I think it's just good business practice and really what the regulators are looking at from a best practices perspective. Now, another cause of concern, and I think this has really got the regulators kind of antsy as well, is we actually looked at the banks that actually have over a 300% concentration, and we looked at the last 8 quarters, and as you can see here, the concentration levels have risen. So from 319 all the way up to 350% over the past 8 quarters. But when you look at the reserve levels to total loans, that ratio has gone down. And so I think, Scott, you might be able to chime in here a little bit from a regulatory perspective, but I would say that's not a trend line that would kind of give the regulators a kind of warm, fuzzy feeling.
Yeah, I mean, when Greg showed me this slide, I thought I was going to have a stroke because this is very problematic. And this is exactly the kind of data that the regulators are focused on when they get aggressive with analyzing our balance sheet and our risk management practices. You know, we often hear about this notion of directional consistency, which the regulators tend to say, as your loan portfolio is growing, so should your ALLL balance. But what Greg is introducing with this slide, and it's critically important, is there needs to be directional consistency with various risk matrices. And in this case, when we look at the concentration, as your concentration in CRE is growing, and there's not one person at FinPro who thinks that's bad, by the way, as long as it's done properly. But as that concentration in CRE is growing, your ALLL balances should be growing appropriately. This trend is really a problem, and this is something that everybody on this call needs to look at and determine whether it's relevant to your financials.
And so, you know, everyone's, you know, heard about CECL, and that's coming down the pike in a few years. So the ALLL methodology now that looks at the 9 qualitative factors, we really need to be taking a harder look at these because what I know just from, you know, experience with my client base, we go back and look at the last rolling 8 quarters, the last rolling 12 quarters, and because we put on so much volume and that volume has performed to date, it seems like there's not a need to put more reserves away, and I think that's counter to what we're really looking at.
Yeah, and Greg's right. You know, so the old FAS 5 AIC 450 has the historical loss portion to the analysis, and then it has the qualitative factors, the 9 qualitative factors. One of the 9 qualitative factors is concentration. So, you know, as Greg's pointing out here, we really need to be vigilant in our qualitative factors under AIC 450 to get it right. And make sure you're having it validated by an outside party, whether that's FinPro, we do it, or whether it's your internal auditors or your accountants, but make sure someone who's very knowledgeable in this area is validating your ALLL and very specifically your 450 qualitative factors.
So moving on and looking at an analysis of yields on commercial real estate loans over the past 8 quarters as well, and this is regionalized, you can basically see that pretty much for the past over an 8-quarter period, yields have come down. And I don't think that's surprising. I think competitive pressures to get earning assets, strong earning assets on the books has really pushed this down. The only reason I point it out is, again, yields are at all-time lows. Okay, so we're underwriting credit and looking at the availability to pay based on rates that are at significantly low levels. So what happens if interest rates start to rise, and all of a sudden we have to refinance these credits when they come due for maturity? Will they have the same capacity to pay?
This is an interesting chart from the perspective. I take this one of two ways. I look at this chart and I say, for those institutions on this call or institutions across the country that we work with, if you have available liquidity and can deploy that liquidity, because right now your securities portfolio is not earning enough, if you can deploy some of that excess liquidity into earning assets in these kind of 4.5 to 5 to 5.5 range, that's really good for your bottom line. So there's a group of the audience that I say, well, that's very strategic, good move. But then there's another group of the audience that we have a rush to the bottom where we're underwriting these loans and we're pricing them because we have good customers coming in saying, if you can't meet this pricing, I'm going to go down the street and I'm going to get it. And that's the rush to the bottom that's driving some of these yields that are going to be really problematic for us. And I would think everybody around the table here, I don't know if anybody's got any stories, but everybody around the table here has seen this with our clients and with others.
And actually, yeah, Scott, that's a good point. I was actually on the phone with a client yesterday who actually has a very, they adhere very strict to their own board internal policy in terms of concentration. And they actually use, I think, 3.25. But what they're doing is says, look, we got $25 million of capacity this year before we hit our limit. Okay, we're reserving that for our best customers, right? The customers that come back to us time and time again. So if you're a new customer and you're kind of looking to do a quick transaction, we're gonna price it up probably a little bit, but we're gonna give our preferred pricing to our real strongest customers. And so what they're doing is really, so they're telling their lenders, don't just chase any deal because we only have so much bucket that we can fill up to go after the best deals.
Yeah, and I've got a number of clients that are struggling because they're putting on substantial gross volume, but the runoff because of this factor is so strong that their net growth is relatively low. And that, I think, Scott, is your point. That's what's forcing people to drive down to increase that net volume, and we don't want to do that.
Yep, that's a good point. The other thing I take away from this slide, again, it makes sense, is that when I mentioned the Mid-Atlantic and Northeast, that's the highest level of concentrations of commercial real estate. It's no surprise to me that the competitive pressures there, they're the lowest yielding loans across the country. So again, it is a tale of kind of where you're at in terms of a regional base. All right, so that's the industry kind of data in terms of where the banks are across the country. I'm going to switch gears a little bit now and really talk about the market data, the underlying market data that we reviewed. And I got to tell you, I reviewed thousands. I could have put 1,000 pages into the presentation, but Scott would have hit me over the head. There's just my point being is that there's a wealth of information that's out there. And this is just a snapshot. This is the kind of the data that we pulled together. But there's a ton of information out there. So my recommendation is going to be you at your own institution should be reviewing this level of data when you're doing your ALLL methodology, when you're going into loan review, when you're having strategic board meetings, because it's really pertinent to what your strategy you're going to deploy in the future.
And for many of you on this call, this information should be shared with your board as your board is working through strategic plan documents, because this is the kind of information that Greg and others have put together that can document at the board level why we're doing the things that we're doing in the CRE space and where geographically.
Okay. So let's jump into it. So what this page here represents is a pricing of commercial real estate. So it's basically a commercial real estate property index chart, and it looks at the last 20 some odd years here and where the index has gone and what the pricing trends have looked like over the past 20 years. And when you look at the normalized trend line, what you can kind of see here is that really two bubbles formed, right? And really, again, going back to the definition of asset bubbles, back right before the crisis, you saw, prices significantly increase, and we're seeing the same level or the same spread between the trend lines here in the current situation. So this is the first kind of chart that I looked at and said, all right, we got to dig deeper because it does look like there's a bubble forming, and I think it's really the basis for what the regulators have been looking at and the Fed and everything in terms of determining whether or not there's a bubble and really heightening their concern. Okay. Moving on, and really the big discussion has been, and I'm sure everyone's heard about it, is cap rates, right? And cap rates on commercial real estate properties have seen a steep decline since 2009 and really are at historically low levels. Now, again, this kind of falls in line relative to interest rates as well. So as interest rates have come down, so have cap rates as well. But again, where we are today, we're valuing properties at the lowest levels in terms of a cap rate basis. So the question is, can we get much lower than where we are today? I don't know, we're at historical lows. I would say there's really nowhere to go but up in this instance.
Yeah, and Greg, look at these numbers because I'm seeing some loans right now being underwritten at 3% cap rates. If you're management boards, if you're looking at loans and you're at a 3% cap rate, take a very close look because that's an inflated value you've got to be very careful with because that's even lower than where these historic lows are right now.
Yeah, and Steve and Greg are really raising an interesting point, and we'll mention it a couple times throughout this discussion, but the notion of countercyclical underwriting deserves some discussion. And the notion here is we have to operate within the economies of our time, but everybody on our side is concerned about cap rates, and as Greg's going to show numerically, but everybody on the call understands as cap rates go up, values go down. So countercyclical means maybe your current policy allows for an 80% LTV. Maybe it's time to start thinking about a 75% or 70% LTV. Or it's certainly time to be stressing the cap rates at underwriting and probably using a floor of a 6% cap rate just to see what it would do to your LTVs and whether we'd have exceptions. So we really need to be doing the right thing because the signs are clear, rates are going to increase, and the signs are clear, the cap rates are going to increase, and the LTVs are going to get walloped as a result.
So taking a little bit closer look at multifamily, because that's where the cap rates are the lowest. And this is a national multi-cap rate chart here that looks at the last several years. But you can see, again, that are at historical lows and are certainly lower than the 12-month rolling cap average since 2005, significantly lower. And, when Scott pointed out 6%, you kind of look at, well, maybe it should be 6.5%. But either way, right, it's really going to be based upon your region and what that normalized rate has been. However, I did think it was interesting that there was actually an increase in the most recent quarter, I should say the third quarter, the most recent available data, that there was an increase in the cap rate a little bit. So the question is that a trend? Have we hit the bottom and are going to start to see cap rates increase? With the 25 basis point rise in December and what the Fed is forecasting, I think if we took a poll on everyone around on this webinar, the consensus would probably be that rates are going to go up. You can expect to see cap rates also follow.
Yeah, and the reason we're all twitchy about this is as rates rise, right now we're focused on cap rates and what it's going to do to value and how it's going to impact LTV. We haven't even introduced the credit aspect of this and how when rates rise, we're going to be at risk of either not being able to refi as loans start to term out, or the actual repayment ability of borrowers are going to be obviously impacted.
So I just mentioned talk about rising rates, and there has been some studies done, and this is a chart that really looks at cap rates and then what the spread is to the 10-year Treasury rate, which is the chart on the bottom here. But there was a study that was done. I think it's like a 22-year-old kind of look back in terms of what the cap rates are relative to the Treasury rates and movements in interest rates. And it was found that there was a 0.7 correlation, which is a pretty strong correlation, one being 100% correlated, negative one being absolutely not correlated. So 0.7 is pretty strong. But basically, if you look at the chart on the bottom corner here, it basically shows that over a 20-year average, there's been about maybe 2.25% spread between cap rates and the 10-year Treasury rate. Okay, so I don't necessarily think it moves necessarily in lockstep. I think there's a lag. It's probably closer to like a 50% beta. But as the 10-year Treasury rate does increase, which it did nearly 100 basis points in the fourth quarter, really in December, you probably could start to see some movement upward in the cap rate. Maybe not the full 100 points, maybe 50, maybe 25 points in the beginning, but you can expect to see, as the 10-year moves up higher, an increase in overall cap rate. And I think maybe Steve, I think you did mention the fact that in some of your client bases, some of the cap rates are down at 3%.
Yeah.
We actually took a look at where they are regionally in some of the major metropolitan areas where cap rates kind of shake out. And certainly, look at New York, for example. New York is down in the 3% range, and it is a little bit different than some other parts of the country, and I think that's an important point. But I think anecdotally, it's nice to look at, right?
Yeah, you know what this map really drills home for me. So a number of us teach at the Graduate School of Banking in Colorado, which I think everybody knows. It's a great school out there. And when we teach and we share our anecdotal perspectives of seeing cap rates at 2.5, 3, 3.25. Look at the cap rates in Denver, and I'm not saying everybody who goes to that school is from Colorado, but it's just an indication. Look at Minneapolis. The geography really does drive the cap rate perspective, and we need to be sensitive to that.
Yeah, I also think it was interesting when looking at, for example, Atlanta, which has made a resurgence and has seen some significant pickup. The cap rates are a little bit higher. Well, why? Because I think the volatility is a little bit stronger, so the risk premium is going to be a little bit higher there, right? So it really depends on which market you're in.
We have a question that came in here. And I'll paraphrase. It has to do with the different markets. Is there as much risk in if you can go back a slide, sure. Is there as much risk in a Columbus market as there is in New York in a rising rate environment, and how does that play out? Does everybody else normalize to a 6% and Columbus stays the same, or does it just have to do with the magnitude of volatility? And I paraphrased the question, so I hope that I did justice.
No, it's a good question. What I would say is it isn't necessarily directly correlated with interest rates. There's a lot of factors that go into cap rates, and one of them being job growth and the stability of the economy in those regions. So I think that's going to be a driver in terms of as job growth or as wages are maintained at current levels or improving, I think you're going to still see cap rates stay relatively low because of the stabilization of that economy, less volatility that's there. But in somewhere like maybe a Columbus or maybe like an Atlanta region, or where there's might be some softness like in Houston or some of the energy sectors, I think you'll see cap rates maybe rise a little bit faster because there's going to be more risk associated with those markets. But I think job growth and forecasts and local economies will really drive a lot of the cap rate and stabilization.
Yes, so I agree with what Greg said. I'm going to answer it a little more succinctly. As the 10-year rises, cap rates will rise across the board. Whether they increase at 100% beta or some other beta may depend on geography. But Stephen, in your question, Columbus is not going to stay static while New York rises in cap rates. It's just not going to happen that way. I think everybody around the table here agrees with that.
And so I'll add my own question here. Insofar as the function of cap rates and concentration, am I correct to say you've identified now two different things that people should be focused on relative to risk and implausible or inconsistent maybe with the future?
I think that's fair. Is that fair? Mm-hmm. Okay. So that's cap rates, right? And that's really a driver of value, right, and valuation. But the other thing is debt service and whether or not the capacity to pay is there. So I also took another look at the net operating income of property types over the last 10 years or so, and you look at the net operating income has gone up for the most part historically. But recently you've actually seen across different industry or property types here net operating income growth, not necessarily the net operating income, but the growth rates have slowed. Okay, and so whether or not that's a trend or a sign of things to come is unproven yet. But it does cause us for some significant concern, because if cap rates are going up, if interest rates, i.e. borrowers' costs are going to be going up and operating income starts to decline, or at least the rate of growth starts to decline, that's going to create some valuation concerns, but also capacity to pay concerns.
Yeah, and Greg, I think anecdotally you can look at multifamily and draw some conclusions from there, because if you were to plot multifamily availability on here and construction, what we've seen over the last 2 years is construction has increased dramatically in multifamily, and more units are coming online. And so what we're seeing anecdotally is more and more multifamily properties where 2 years ago there was pretty significant incentives to come and rent in that property, or there were, no incentives to come and rent that property. Now all of a sudden we're seeing incentives of no security deposit and things like that. So there's an increasing supply factor that's playing into this as well.
It's a great point, Steve. And I actually have a couple charts on that that kind of, I think, support that anecdotal story, which is great. So again, just as a quick snapshot of rents, looking at a 12-month kind of rent growth over the course of really different markets across the country. Some markets are growing faster than others. I look at some of the bigger markets out there, the New Yorks of the world, Baltimore, Philly. Those rates are relatively low. Where you're seeing still very, very strong growth is in the Seattle area, Portland. I'm not surprised by that. You start to talk about where the jobs are and what's really thriving as an industry. That's where you're seeing the highest level of rent growth. So again, going back to my point earlier about why jobs and local economies are important, I think that's a big driver. And right now, those areas are still strong, but some of the older markets, the more mature markets, if you will, are certainly lower than that. So going to this chart here, I thought was pretty interesting in terms of affordability, and you look at annual rent as a percentage of household income. This is for 2016. I don't think it's really any surprise to people around the table or maybe on the phone that New York and Los Angeles are really, really expensive marketplaces, right? When you're talking about areas of 55 to 60% of household income is going towards rent, that's a problem, right? Because if wages aren't going up, how can people afford to sustain increased rent prices going forward? They're not going to be able to, right? And so I think when you look at the median, which is around 35%, I think the trend has to start pushing back. And if wages aren't going to grow, rents could be at risk here, especially with the glut of inventory that's being put on.
So what Greg introduced is one of the critical factors because we started out with, is there a bubble? And the question really is, where are each of you playing within this CRE space? And I know a lot of the bankers on the line right now are heavily concentrated in the multifamily arena, but quite frankly, they're dealing more in what we might call the blue-collar space. So even though they're in the highly competitive areas of New Jersey or New York or Philly, this chart right here, rent as a percent of median household income, is in a very normal range. There's others that are playing in the really high-end space. That high-end space is going to get blasted, right? There's no doubt about it. As the bubble bursts, it's going to start with the highest-end market. And those markets where people are paying 50, 60, 70% of their income to live in a certain area, they're the people who are going to downsize to something more reasonable, and that high-end market's going to evaporate real quick.
And so for sake of time, I'm going to skip through here. I'm actually going to go to page 22 here, 22, and look at really what we're talking about with that is average rental rates, right? And so, Scott, to your point about the higher end market starting to see a decline, look at New York, for example, and San Francisco. Those have been the hottest and highest costing markets, right? And so year over year, though, we're actually seeing declines now in average rent prices for one bedroom and 2-bedroom units. Okay, so increased inventory, but the overall affordability, because wages have stayed relatively stagnant, even though unemployment's gone down, the higher paying jobs aren't as prevalent, rents are starting to come down, right? And so NOIs are going to get hit. Start looking at NOIs get hit. And actually, and specifically in New York, there was a research piece in an article that was put out that actually looks at the median price for, this is Manhattan in New York City, resale apartments fell for the first time in almost 2 years.
Can you go back to that prior slide, though? I just want to be sure that everybody is following the trap that Greg is laying here, because he's already gone through cap rates and pretty much put a stake in the ground that cap rates are going to go up. And now he's slowly but surely introducing what's going on with rents, and there's a lot of red on this chart. There's a lot of year-over-year decrease, even in these expensive markets, which is going to now start to hit our overall revenue stream.
Right.
Okay.
Exactly.
So is 10% stress in a bubble popping a plausible scenario? An outlier?
I think that's a reasonable. I mean, that would be my first scenario.
But that's the trap kind of we're introducing here. I would have thought 12 months ago, if you asked me a 10% scenario minus, is that plausible or is that even feasible? I'd say maybe no. But that's often reminiscent of the thinking that happened in 2007.
Exactly. Good point. So again, going back to this article here, I'm just quickly again, Manhattan resale apartments fell for the first time in almost 2 years. Again, new construction being put on, and we tried to do some more research on this to figure out to why they've declined. You couldn't put your finger on a point, but kind of reading through the article and doing some research, what it really came down to is that the purchasers in the marketplace have really made lowball offers, and inventory is moving quicker. So people aren't pricing it up higher, and the inventory isn't lagging. Inventory is moving because prices have come down. So people are pricing to sell to get out, which I think is probably the reason why you're seeing this price decline. Whereas maybe a year or two ago, they were pricing kind of overly high. I think now because of the inventory that's now on the market, people just want to get out, so they're taking lower offers. Now I'm going to jump over to vacancy rates, because vacancy rates is also an important point in terms of how much income you're going to be able to generate off of your property. And again, just a historical look back at vacancy rates. Now this is going back quite some time, over 50 years. The St. Louis Fed, by the way, puts out some really good information. It's a great data source. I highly recommend it. But you can see here that vacancy rates, again, have fallen down to 30-year lows. Okay, so it's certainly not as low as it was back in the 70s, but again, looking at the past 30 years, we're at low levels. And again, with the amount of inventory coming on, you got to believe that vacancies are going to be going up, not necessarily down. Okay, so again, across different property types, you can kind of look at here more recent trend of different types here, and you can notice that while office space has come down, it's still relatively high at 10%. Retail relatively high at 11.5%, but multifamily is at 4.8. The forecast, based on the National Association of Realtors, the forecast is for those vacancy rates to start to rise. Okay, and if you look at where cap rates are, at really, really low levels for multifamily, but vacancy rates start to rise, you kind of start to paint the picture of the bubble that is really about to, let's say about to burst, but is forming and will burst at some point.
And I think because Greg's giving us a lot of great information and still has a lot to share with us, and if there's anyone on the phone who might be saying, well, this is great info, it's macro, and it doesn't apply to Minneapolis, or it doesn't apply to LA, or whatever the case may be, please remember this is the kind of data that the regulators are focused on, and this is what's driving them to be so aggressive in looking at the whole commercial real estate market and the underwriting. So even if you're not buying into the concerns that we're raising here about a potential bubble, or if your particular geographic area doesn't align to this data, just please remember that the regulators are laser focused on this kind of material.
So where are vacancy rates going to go? So I like this chart here because it really says, okay, if vacancy rates are less than 5% today at 4.5%, if you look at a long-term run of vacancy rates, the average is about 5.5%. So again, going back, Stephen, to your point about stress testing, what's a good number to kind of use as a starting point? Well, 5.5 may be that number, right?
But if we're at 4, that's a 50%. That's almost 50% stress. So when we say, oh, we're going to shock up our vacancies, you're such a deflated percent that 50% increase in vacancies only takes you from 4 to 6.
Correct.
So we got to be realistic about absolute numbers versus percentages. But I'm glad you brought this up because I'm keeping a list. I'm assuming it's on the checklist of the things that you've introduced that we should be stress testing. And with Steve, the Lonos expert here, maybe at the end we can touch on the data necessary and the stress test and make sure my list matches with what banks' expectations are.
100%. Good point. So what does it all mean, right? So I think we've introduced now the fact that, and hopefully everyone hasn't started running for the hills here, but really what does it all mean? And Scott made a really good point earlier. It's not that banks with 400 or 500% concentration are necessarily doing anything wrong. Right? That's the asset class they play in, that's where their expertise is. But how are we doing it in a prudent way that if this bubble were to burst, we're going to be able to minimize or mitigate the overall risk to the institution?
Yeah, and I want to underscore what Greg just said. I mean, we have clients that are 600-700% concentration in CRE. We have clients that we've gone with the client to the various regulators and proven and documented that the risk management practices are appropriate and the underwriting is appropriate for those kind of concentrations. So please don't take anything that we're saying as concentrations in commercial real estate is bad. As Greg just said, depending on your expertise and where you're located in the country, it's the right way to run a bank and make money. But we have to know where the risks are, where the pressure points are, and we've got to be prepared for them. And I think that's where we're moving into now in the presentation.
Right. So what does it all mean? Now I just want to get everyone's attention with this picture. All right. So low yield, low cap rates, less reserves, and we're seeing much more interest-only type of structures. That is an iceberg that's way out there in the fog that we might not be able to see just yet. We got to be able to navigate through it. So I just really wanted to quickly do just a quick exercise, and most people on the phone here know how all this works, but for some of you who may not understand necessarily the relationship between cap rates and value and net operating income, I just wanted to go through a quick exercise with you. So, cap rate really is net operating income divided by the value of the collateral, right? So therefore, if we're trying to determine the value of the collateral, you need to understand what the net operating income of the property is, and you divide that by the cap rate to get the value, right? So when you look at this hypothetical example here, okay, this is a loan that was underwritten at a 75% LTV, got an NOI of $45,000, written at a 4.5% cap rate. The collateral value is worth $1 million, right? So what happens if the cap rate changes, right? Over the next couple years, one might assume that the cap rate can go up to 6%. Where, Scott, to your point, we should be at least stressing it at 6%, right? Well, if the NOI stays exactly the same and the cap rate goes to 6%, well, now the value of that collateral is $750,000. Now you're at an 100% LTV, okay? And that's only a 150 basis point increase in cap rate.
So let's just kick around. The math is basic, the concept is basic, but just let's kick it around a little bit. Because previously we mentioned countercyclical underwriting. This is an example of countercyclical underwriting. Steve Brownklinger just mentioned the importance of stress testing. Steve Musso is in the room, who's really generating the Lonos product that does loan-by-loan stress testing. The concept here is if we all start with the notion that a cap rate of 4.5% is at risk in today's environment in 2017, 2018, 2019, then we have to minimally be stressing that 4.5 rate. Now the problem here becomes a data collection problem, in that many of the banks on the line probably do not have a database that is showing the cap rates. Frequently, and I'm going to ask Steve Musso and Greg to add in some comments here in perspective. But what we'll often see is appraisal amount, appraisal date, LTV. Rarely do we see in a database vacancy rate or cap rates, so it becomes a real challenge that there's not data available in the database. It's clearly in your collateral files, but it's not in a database that allows for the modeling and stress testing. So I'm going to stop and ask either Steve or Greg if they want to add anything to that.
Yeah, Scott, I'll add a couple thoughts to it. I mean, there's definitely the challenge of capturing the data. There's a number of systems out there that do it. Some banks have done a good job of capturing the data. Others are trying to use core fields, user fields on their core system to capture the data they need. But like you said, rarely are we getting the detailed data we need. So we might get the LTV or we might get the DSC ratio, but we're not getting the detail behind it so we can adequately stress test it. So we have to capture that data to do it, and there's not a lot of systems out there that are efficient at doing that. And the other challenge is, remember, from your underwriting standard, there's really 3 debt service coverage ratios, not just one. You're going to do a debt service coverage on the property, you're going to do it on the borrower, and you're going to do a global debt service coverage ratio. and then you're going to underwrite to one of those. It's the one you've picked, and that's the one you've done your underwriting to. So stress testing can be very complicated because we have to determine which ratio is the right ratio to be using and which one we should be stress testing off of.
And I know if Don's traveling today, he's at a client site, but if he was here, he'd want to talk about the importance of data as it pertains to rent rolls, maybe using an example of a mixed-use property with a commercial space on the bottom and residential units on top. One of you guys want to talk about that a little bit and the importance of the rent rolls?
Well, yeah, the rent rolls are critical for a number of reasons because we have to look at the different types of units and what the rents are on the different types of units and the vacancies, but we also have to be able to look at what's the exposure there. So if you've got a mixed-use property, how much of the exposure is coming from the commercial unit or retail unit versus the residential unit. And then you have to dig further, and so, you know, a quick pitch, but we're going to get into this in a lot more detail on February 2nd because the February 2nd webinar is really on detailed stress testing. But you have to go further, think about if you have a bunch of mixed-use properties or if you just have a bunch of, say, small retail properties, who are your tenants? If you have 11 properties where you have 7-Eleven as your primary tenant, then we need to know what's going on with 7-Eleven, not just those properties. So we really have to dig deep with the data, and as you said, Scott, that's our biggest challenge. In the last 3 stress testing engagements I've done, we've iterated back and forth with the client over 7 times to get the proper NOI data we need to be able to stress test. And Greg, you know that because you've worked on a few with me.
That's exactly right. The other thing I would just mention here, and it's later in the deck, but I think this is a good deck to take with you as a takeaway as well, but it's at least terms as well. When those tenants are coming up in terms of, you know, if you're doing a 10-year commercial real estate loan, but the 2 or 3 key leases are coming due in 3 years, well, you're at risk because what if they go somewhere else, right? And then you got an unoccupied space. So you need to be looking at those things as well and capturing that data as well. Again, just another quick example here, and I'm going to breeze through this one for sake of time, but again, looking at NOI, and Stephen, to your point earlier about if vacancy rates do move, you know, what happens to NOI? In this example here, if vacancy rates went from 4.5 to 5.5 in this just simple example, you know, what it does to the NOI and how that affects the value as well in a simple ratio. So again, these are very important things to look at in terms of the value. And so I'm going to skip through this. One quick chart I do want to point out, though, is looking at the commercial mortgage-backed market, CMBS market, in terms of, you know, commercial mortgage-backed securities. And I thought this was just 2 seconds on this page. Looking at the CMBS index, this is the Bank of America CMBS index. So basically, it's tracking the value of that index. And I thought it was interesting when you're looking at the amount of commercial real estate being put on, low vacancy rates, you know, continuing growth in NOI. You know, why did this index start to fall in the second half of the year? Right? Why did people start to get out of commercial real estate mortgage-backed securities and the value fell? I'm not smart enough yet to necessarily know that, but I would say that the investment community is looking at commercial real estate and noticing that there is a bubble on the horizon, and people are getting out now while they can. We're seeing a little bit of an increase back up, but I think this is something that to monitor going forward as an indication or maybe a leading indicator of where commercial real estate is going. So now I'm going to jump on, Scott, maybe you could spend just 5 minutes or so on the regulatory view and kind of go through some of the things that you want to cover from a regulatory perspective.
Yeah, it's not too often you're going to hear me say I'm going to blow through the regulatory stuff, but we only have 10 minutes left, and there's one important section after regulatory that Greg needs to get through. This is all self-explanatory. This is simply, and so you can use this material for reference if you wish. This is a list of all the regulatory guidance that's out there. And you'll see the 2015 guidance. The 2015 guidance really focuses on this notion of global cash flow. The concern that I have a little bit is if we were to line up 10 experienced credit analysts and ask them all to define global cash flow and how they do it, I'm afraid that we would not get 10 identical answers. So we really need to ensure that we are properly calculating global cash flow. And we also want to be sure that our loan policy establishes the risk thresholds for cash flow versus global cash flow. So it's not uncommon to have a cash flow threshold of 125, but a global cash flow of 110 or maybe even 1. But your loan policy should address it, and we're encountering a number of loan policies that do not. The 2006 guidance, which I'm sure everybody is very familiar with, has 7 points. These are the key points on this slide. We'll just blow through some of them quickly. This particular slide talks about the responsibilities of the board and management, and it's all about the strategic plan. And where we're seeing most criticism from the regulators is that a bank's strategic plan does not properly identify all of the benefits and all of the risks associated with the concentration. So we want to be sure that that strategic plan, which in the past has been driven primarily by numerical analysis, also is equally addressing all of the risk management practices. So let's look to the next slide. There's 4 key areas on this slide that the board's expected to accomplish. Number 1 is really ensuring that you have the right kind of enterprise risk management process. If you don't have an enterprise risk management process, you better have a risk appetite statement. If you use a FinPro enterprise risk management, that really is your risk appetite statement. Point number 2, we recommend to our clients that the cover sheet to a loan package should have an affirmative statement by the loan officer that their loan is in compliance with all laws, regulations, and the bank's loan policy. That's the way to really check the box for number 2. Number 3, whether you're using a tool like what Greg is presenting today or other tools that are out there, really need to be talking and documenting at the board level and in the board minutes what's going on in the commercial real estate market. And obviously, it's incumbent upon the board minimally once a year or more often as appropriate to reset the thresholds and the limits. Always want to be focused on correlation between various segments. So, as you all know, the hotel industry has a high correlation to the restaurant industry. So, depending on your particular portfolio, it's not good enough just to look at the 10,000-foot level. You really want to look at the type of lending that you're doing and the correlation between those particular industries. All of you who do have a high concentration in commercial real estate should have developed or be developing contingency plans to reduce your exposure as necessary. Think about it this way. If you go to the board and you decide that you have enough information to be concerned about the commercial real estate market and it's time to reduce your exposure, your contingency plan would explain how you would reduce your exposure. It can be reduced by cutting down the pipeline. It can be reduced by selling. Many of our clients have the contingency plan that's predicated on selling. If that is your contingency plan, you absolutely positively, according to the 2006 guidance, have to periodically sell to demonstrate that you can exercise that contingency plan. The next slide talks about the MIS system. It's self-explanatory. Steve, Musso, and Greg have already talked about the difficulties with data. Your MIS system, if you have a high concentration in commercial real estate, your MIS system has to minimally address the points on this slide. And believe me, there's 50 other points that we would drill down to, but the points on this slide truly are non-negotiable. The next slide talks about credit underwriting. Again, the slide's self-explanatory, but it identifies what needs to be in your lending policies. So please take a moment and compare this slide to your loan policies, especially if you are a concentrated institution, so you can be sure that nothing's fallen through the cracks. The next slide talks about a market analysis. This is one of those areas that please pay attention to this, because we've gone in to help a number of new clients that had high concentrations that thought they were perfectly aligned with the 2006 guidance. This is one of the areas that always trips up banks. You have got to be using data. Again, data like what Greg's gone over or other industry experts, but presenting this data to your board about what's going on, not just with products in the commercial real estate arena, but geographically what the economy is doing. And then the last slide I want to cover, well, the 2 more slides, policy exceptions. Policy exceptions have to be reported to the board. It's non-negotiable. And just look about halfway down this slide. You'll see what sort of details expected in the policy exceptions. So please focus on number, nature, justification, and trend in policy exceptions. It's critical, and it's something that needs to be monitored and documented in the board minutes. And then lastly is stress testing. We've talked about stress testing. Steve Musso has already said that in February, what's the date?
February 2nd.
February 2nd, it's going to be an entire webinar focused entirely on stress testing, something that we would hope you all would join. So that was a fast recap of the regulatory side, because in the last 5 minutes, Greg's got to attack this last part.
Yeah, and I think a lot of the stuff that Scott just talked about really dovetails into what banks should be doing to protect themselves. It just goes into a little bit more detail. I'll try to get through as quickly as I can, but feel free to read through it and call us with any questions you may have on this. But the first one really starts off with data capture. I'm not going to beat a dead horse on this, but again, it is critical to start capturing this data if you got concentrations, but also to start preparing yourself for what's going to be in store for you with CECL, right? So I think it's just a good business practices, and I think it's becoming best practices within the industry to capture this data, use it to your advantage in terms of portfolio management. As Scott had maybe mentioned earlier on, we talked about breaking down the portfolio into different segments, granularizing the portfolio from a concentration perspective. Those of you who are either approaching or above 300% need to be doing this, no doubt about it. But we highly recommend it for everybody, because I think understanding your exposure across the universe of different property types is really critical. So you can kind of see here, you want to put realistic limits in place, i.e. risk appetite in place, really, and it should surround around your level of expertise. So if you're really good at multifamily lending, you're probably going to have a higher concentration.
And this kind of stuff has to be in your enterprise risk management, and it has to be in your strategic plan, and they have to align.
Stress testing is another critical component. We don't just recommend stress testing one variable, if you will. We recommend stress testing scenarios, right, and a whole host of scenarios that might touch one variable or multiple variables, and understanding where the pressure points are in your portfolio. It may be because of NOI. It may be because of cap rate. It may be because of vacancy rate. Whatever it may be, we should be stress testing different economic situations and producing a whole host of outcomes, because no one knows necessarily with a crystal ball where the economy is going to go. So whether it's going one way or another, we want to know where our pressure points lie. Kind of further along that note, and I think stress testing is so critical to this part of the process, is to understand which loans fall out and which loans fail. Right? And then ultimately what the impact is on capital. This starts to bring in enterprise risk management into play in strategic planning, because if I know that I got X dollars of loans that could fail, that could create some type of loss in the institution, what does it do to my capital position? This is where an enterprise risk approach is really appropriate here to make sure what the impact is on capital. Lastly, and you start breaking down stress testing, is doing individual write-ups on each of your loans that fail the test. So you can really do what I'll call a kind of a crisis management or a mitigation plan on these credits if this were to occur. And so our lending staff is talking to these borrowers, is touching these borrowers more often, and is paying attention to the credits that are at risk. We talked about the non-qualitative factors. I think this is also a key adjustment here. It's something we need to be focused on. And really lastly here, it's really looking at some of the different policies and some of the underwriting criteria you're currently doing, and looking at some maybe key things. Scott mentioned 6% cap rates, underwriting loan terms to shorter than key leases. So if key leases are coming due in 2 or 3 years, why are we writing 10-year notes? Reducing LTV volumes or debt service coverage ratios, and then also adding limits to policy exceptions. I think those are really, in totality, there's a whole bunch of host of things that we're going to have in the checklist. I highly recommend you emailing me or Scott, primarily me, because I don't think Scott wants to have his inbox flooded. And I'll make sure you get the checklist sent out. So thank you so much for joining our webinar. I did want to hit 2 quick things. We do have a webinar coming up next week. And Scott, I want you to touch a little bit about that. It's a free webinar for anybody, for all of our client base. So Scott, do you just want to touch upon it?
Yeah, I'm hoping everybody has gotten notice about the avalanche of litigation surrounding community bank websites and the Americans with Disability Act. This is a huge issue. There's a couple law firms around the country that are just blasting community banks with demand letters. Many of you may have gotten some of those demand letters. There's a lot of confusion in the industry right now as to how to handle those demand letters. The Department of Justice has gotten active in a couple areas. So please join us. It's next week at 11 a.m. We're going to have a law firm walk through a number of key issues for dealing with this situation. We're also going to have an outside auditing firm that does audits of websites for ADA on the call. So there's just going to be some great information shared. It's a free webinar, and it's a crisis issue for community banks that we need to all coalesce around.
Thanks, Scott. And then that's on the 18th. And then on the 2nd, Steve, right, we're doing a CRE stress testing, which will go in much more depth with really how to do and what's best practices for a commercial real estate stress testing, correct?
Correct.
And that's going to be at 11 a.m. So, you know, for those of you who are not global webinar package participants, that's something you want to sign up for. Just a quick promotion on the global webinar package. If you're not a part of that already, it's for, you know, relatively low cost, $1,500 to $1,700, depending on whether or not you're an existing FinPro client. You get access to all of our webinars, unlimited user access. So you can register, you know, 10 people in your organization, or you can register 100. And they'll have access to all of our webinars. If you're interested more in that, please contact us. We're more than happy to give you some information there. And then lastly, for those folks who may not have joined at the beginning and are looking for those New Jersey CPE credits, again, what you want to type into the dialog box there is CRE 2017. And for those of you who type that in, we'll make sure that you get the proper information to apply for your credits. Outside of that, I hope everyone has a great day. Right here in New Jersey, it's about 50-something degrees, which is strange, but it's nice to have for a change. So anyway, thank you everybody for attending. Look forward to seeing you on the next one. And one last thing, since this is such a hot topic issue, I'm thinking about actually re-hosting one of these 6 months from now. And so for those of you who are on the line still and would like to participate in that, we'd welcome and maybe have some of you speak and present from a more local perspective in your different regions. And so I welcome that. So please contact me, because 6 months from now, I want to host another one of these, see where we're at. Okay? Thank you, everybody, for attending, and we'll see you on the next side. Okay. Bye-bye.